funds are generally considered as one of the most fruitful investment options as it plays a very crucial role in achieving your financial goals early. One of the greatest benefits of investing in mutual fund is that they are tax efficient investment instruments. Now, investing in mutual funds can reward you with tax efficient rewards. Now, when you're planning to invest in mutual funds, you're most likely to make mistakes as you will not consider the taxes levied on your returns. Thus, in order to maximize your returns on the returns that you get on mutual fund investments, you need to be aware of all the taxes that are levied on the returns. Hi, I'm Namita. Welcome to IndianMoney.com, and in today's video, let's understand how much of taxes are you likely to pay towards your mutual fund returns. Before we go to the taxes that is levied on the returns, let's first understand how are you earning your returns on mutual funds. Now, mutual fund investors get returns in two ways. The first is dividends and the second is capital gains. Now, dividends are basically paid out of the profits of the company, which means that when the companies are left with surplus cash, then they may decide to share the profit that is made with the investors as well in the form of dividends. Investors receive dividends that is equal to the number of mutual fund units that they hold. While on the other hand, the capital gain is the profit which is made by the investors if the selling price of the security which is held by the investors is greater than the purchase price. While in simpler terms, capital gains are made due to the appreciation in the price of the mutual fund units. Now, the returns that is earned by the investors are in the form of dividends or in capital gains, both of them are taxed. So let's understand how are dividends that you receive as a form of returns, how are they taxed? Well, dividends are offered by any mutual fund scheme that are taxed in a very classical manner. That is, the dividends received by the investors are added to their taxable income and they are taxed at their respective income tax slab rates. Well, let me tell you that previously the dividends were tax-free, which is the investors did not have to pay any kind of taxes, as these taxes were paid by the companies in the form of Dividend Distribution Tax before they had shared the profit with the investors in the form of dividends. Now, during this regime, dividends that were up to rupees, say 10 lakh in a year were tax-free in the hands of the investors. Well, any dividends that they received that exceeded rupees 10 lakh per in a one financial year, that attracted dividend distribution tax at 10%. Moving on, we'll now understand if you're gaining any kind of capital gains, how are they taxed? Well, the taxation rate of the capital gains of mutual fund depends on the holding period and the type of mutual fund. Well, the holding period is basically the duration for which the mutual fund units were held by the investors. In simpler words, the holding period is the time between the date of the purchase and sale of mutual fund units. Now, capital gains can be broadly classified into two categories, which is short-term and long-term capital gains. Now, with the help of a table, let's understand what constitutes short-term and what constitutes long-term. Now, as you see in the table, the first column talks about the fund type. That is, if you're investing in, say, equity funds and you're getting the capital gains within 12 months, then that is constituted as short-term gain. Whereas if you're redeeming your capital gains after, say, 12 months and or more than that period, then that is considered as long-term capital gains. The next one is debt funds. If you're investing in debt funds and you're taking out the capital gains, say, within 36 months of time, then that is short-term gain. Whereas if you're taking or you're redeeming your investments after, say, 36 months or more, then that is considered as long-term capital gain. The next one is hybrid equity oriented funds. Now, if you're investing in this fund and you're taking out or you're redeeming your gains, say, within 12 months of time, that is 1 year, then that is considered as short-term capital gains. While on the other hand, if you're redeeming your investments or your returns after 12 months, then that is considered as long-term capital gains. And lastly, hybrid debt oriented funds. If you're investing in this fund and you're redeeming your capital gains within, say, 36 months of time, then that is considered as short term. And on the other hand, if you're redeeming your returns after 36 months of time, then that is a long-term capital gain that you're making. Moving on, let's now understand how are your returns if you had invested in different funds, how are they taxed? Starting with STT, which is Securities Transaction Tax. Now, apart from the tax that the investors have to pay on dividends and capital gains, there is another kind of tax they have to pay, which is called STT or Securities Transaction Tax. tax. Now let me tell you that an STT of 0.001% is levied by the government whenever you decide to either buy or sell your mutual fund units of either the equity fund or hybrid equity oriented fund. Let me also tell you that there is no kind of STT that is levied on the selling of debt fund units. Moving on, we'll now understand how are capital gains that you get on equity funds, how are they taxed? Now, equity funds are those mutual funds whose portfolio's equity exposure exceeds 65%. Now, as we had seen in the table previously, you make short-term capital gains when you redeem your equity fund units within a year. When you redeem your gains in less than 12 months, then you are taxed at a flat rate of 15% irrespective of your income tax bracket. You make long-term capital gains on selling your equity fund units after holding that for 1 year period or more. Now, these capital gains of up to rupees 1 lakh in a year are tax exempted. Now, any kind of long-term capital gains that you make that exceeds this limit attracts long-term capital gain that is taxed at the rate of 10%, and let me tell you, there is no kind of benefits on indexation provided. Moving on, we'll now understand the capital gains that you make out of investing in debt funds. How are they taxed? Well, debt funds are those mutual funds whose portfolio's debt exposure is in excess of 65%. Now, as we had seen in the table previously, you get or you make short-term capital gains on redeeming your debt funds unit within the holding period of say 3 years. Now, these gains that you make are added to your taxable income and they are taxed at your income tax slab rate. While on the other hand, when you make long-term capital gains that are released when you sell the units of the debt funds after the holding period of 3 years. Now, these gains that you make are taxed at a flat rate of 20% after indexation. Also, let me tell you that you are levied with the applicable cess and surplus on the tax as well. Moving on, we'll understand the capital gains that you make by investing in hybrid funds. How are they taxed? Now, the rate of taxation of capital gains that you make by investing in hybrid or balanced funds is depending on the equity exposure of the portfolio. Now, when the equity exposure exceeds 65%, then the fund scheme is taxed like an equity fund. If not, then the rules of taxation of debt funds will be applicable. Now, therefore, it is essential that you know the equity fund exposure of the hybrid scheme that you are investing in. If not, when you might be in a nasty surprise on redemption of your fund units. Lastly, we'll look at if you're investing in say through SIPs, then how are your returns taxed? Now, SIPs are basically investing every month, that we all know. Now, when the investor invests say rupees 5,000 per month at the end of 2 years, and then the invested amount would become say rupees 1.2 lakh. Now, let's assume that you want to withdraw the invested amount of say rupees 40,000. Then you'll have to pay short-term capital gains as the period for which that is required to arrive at rupees 40,000. With the monthly SIP of rupees 5,000 is only 8 months. When it is less than 1 year, then we have understood that it is a short-term capital gain that you make. So, when you take out that sum within the less than a period of say 12 months, then you're likely to pay short-term capital gain tax. Now, let's take another scenario and understand when you want to withdraw, let's say rupees 80,000, which gets accumulated after a year, then it becomes long-term capital gains, and then thus you don't have to pay any kind of taxes until it falls under your tax slab. Lastly, let's now understand if you're investing in any kind of non-equity based schemes, how are your returns taxed? Now, under any non-equity funds, if you withdraw your returns, say in less than 3 years of time, then it naturally becomes short-term gains that you're making, and then you will have to pay tax based that will depend on your tax slab rate. Now, on the other hand, if you choose to withdraw the same amount, say after 3 years of time, which again becomes long term, then there are no kind of taxes that will be levied on your returns. So, this was all about how your gains, either you're making it via dividends or you're making it via capital gains by investing in mutual funds, they are taxed accordingly. For more such financial content, do subscribe to our channel, like the video, and also do not forget to hit on the bell icon to get notified for our next video. Also, let me tell you, if you're a person who's interested in investments, either in mutual funds or PPF or any kind of instruments, then download our Financial Freedom app, wherein we'll give you A to Z details about each of these investments to acknowledge you more about it. Thank you for watching IndianMoney.com. Get wise, break free.